Welcome, everyone, to our first lesson on choosing the right form of ownership for your business. Today, we'll explore the key decisions that need to be made in this process. Choosing the form of ownership for your business is a critical decision that will shape its structure, operations, and legal obligations. Whether you're starting a new venture or restructuring an existing one, understanding the options available to you and their implications is crucial. Let's dive into the different ways you can own a business, starting with how you pick the right one. We'll use a helpful diagram to guide us along the way, mainly focusing on sole traders, partnerships, and private companies. So, first things first, let's talk about legal persona. Imagine you're a sole trader. Your business and you are basically the same thing. This means that any legal actions or liabilities are directly attributed to the individual proprietor. So, if something goes wrong, it's all on you. Same deal with partnerships. In a partnership, the business entity itself lacks a distinct legal persona, meaning the partners assume full responsibility for any legal obligations or disputes. But here's where it gets interesting. With a company, things change. When you register a company, it becomes its own legal person. This means it can buy stuff, own property, and even sue or be sued, all on its own. It's like a separate person, just with a team of lawyers instead of a mouth. In simple terms, while sole traders and partnerships mix the business with the owners, a registered company stands on its own 2 feet legally, with its own rights and responsibilities. When it comes to liability for debts, there are 2 main types: unlimited liability and limited liability. Unlimited liability means that if your business cannot cover its debts, you're personally on the hook. This means your own property could be used to pay off what's owed. Sole traders have unlimited liability because they and their business are basically one and the same. So, if the business fails, they're responsible for all the debts, and their personal assets could be used to cover them. Partnerships work similarly to sole traders in this regard. If the partnership cannot cover its debts, the partners are personally responsible for paying them off. Limited liability, on the other hand, means that if your business cannot pay its debts and it fails, the responsibility for those debts falls solely on the company, not on the owners personally. So, if a company cannot cover what it owes, debt collectors can only go after the company's assets, not the personal assets of the owners. In simple terms, with unlimited liability, you're personally responsible for your business's debts, but with limited liability, the business stands on its own when it comes to paying off what it owes. When it comes to tax implications, there are different approaches for sole traders, partnerships, and companies in South Africa. For sole traders and partnerships, taxes are calculated using the progressive income tax system. This means that the amount of tax you owe depends on how much money you, as the business owner or partner, receive. So, regardless of how much your business earns, any money deposited into your bank account from the business or elsewhere is used to determine your tax liability. Tax rates can vary from 0% to 45%, depending on your income level. On the other hand, companies follow a different taxation method. They calculate taxes based on their profits, which is the income minus expenses. This means that taxes are levied on the company's net profit for the financial year. Tax rates for companies typically range from 28% to 29%, depending on the specific financial year in which the business was established. In summary, while sole traders and partnerships pay taxes based on personal income, companies are taxed on their profits after deducting expenses. Another crucial factor in choosing a form of ownership is the continuity of existence. which refers to the business's ability to continue operating even if the original owner or founder is no longer. For sole traders, continuity of existence isn't feasible. If the owner passes away, the business essentially ceases to exist. Any inheritance plans for the business would require it to be picked up by someone else, such as a spouse or child, who would then operate it in their own name. In South Africa, upon the owner's death, the estate is frozen and the business operations would need to be conducted through the inheritor's personal accounts. Similarly, partnerships face challenges regarding continuity. If a partner passes away or decides to leave, a new partnership agreement must be drawn up. This effectively marks the end of the previous partnership, and a new agreement establishes a fresh entity with the remaining partners. However, companies offer continuity of existence. Even if the original owner or shareholders are no longer involved, the company can persist independently. This is due to the legal persona of a company, which grants it recognition as a distinct entity in the eyes of the law. The company can continue its operations, be transferred to new owners, and adapt to changes without requiring a complete restructuring. In essence, while sole traders and partnerships face challenges in maintaining continuity if the original owners are no longer involved, companies possess the advantage of enduring as separate legal entities, capable of ongoing operation beyond the involvement of their founders. Management and control plays a crucial role in determining how much authority you're willing to keep or give away in your business. As a sole trader, you retain complete control over all aspects of your business, which is understandable since you're the only person in the business. In a partnership, management and control are determined by the partnership agreement. You and your partners decide how responsibilities are divided, and this agreement governs the management structure of the business. Similarly, with a private company, management and control are outlined in the company's founding documents. Directors' roles and responsibilities are defined, and decisions regarding control are made collectively by the board of directors. In contrast, a public company, which sells shares on the stock exchange, allows public shareholders to have a say in decision-making. In this scenario, decisions must consider the interests of all shareholders, and transparency is crucial. Public companies are legally obligated to produce audited financial statements to ensure accountability and transparency. As mandated by the Companies Act and regulations from the Johannesburg Stock Exchange. When considering forms of ownership, the capital size needed is a significant factor to weigh. Starting as a sole trader is relatively easy and requires minimal capital. Typically, you're testing out an idea or utilizing existing resources, like an old computer, to kickstart your business. In contrast, forming a partnership involves seeking funding from other partners, such as friends or family, who share your business goals. With more contributors, partnerships generally have access to more capital than sole traders. Similarly, starting a private company involves bringing in partners or directors to invest and run the business together. This allows for a broader pool of resources and potentially more substantial investments compared to that of sole traders or partnerships. However, if substantial growth and access to a whole lot more capital are your goals, going public might be the route to consider. By listing your company on a stock exchange, like the Johannesburg Stock Exchange, you can attract investments from the public, providing a substantial influx of capital for expansion. It's important to align your choice of ownership structure with your growth ambitions. If you're content with a smaller scale operation, a sole trader or partnership may suffice. But if you're aiming for substantial growth and access to significant funding, transitioning to a public company might be the best option. It's worth noting that companies can transition between public and private ownership. For instance, companies like Twitter, under Elon Musk's leadership, have shifted from public to private ownership through share buyback programs, allowing for more autonomy in decision-making. When it comes to formation procedures, the simplicity and formality vary depending on the chosen form of ownership. Starting as a sole trader is the simplest route. You can wake up with a business idea and immediately begin operating. While there are fewer legal requirements, it's essential to note that operating as a sole trader still entails legal considerations, albeit less formal than other structures. For those seeking a more formalized arrangement involving other individuals, a partnership might be the way to go. Establishing a partnership involves formalizing agreements among partners regarding profit sharing, decision-making, and liability through a partnership agreement. Similarly, forming a private company entails registering with the Companies and Intellectual Property Commission, CIPC, and drafting a Memorandum of Incorporation, MOI. This document outlines key aspects of the company's operations, such as its structure, governance, and rights of shareholders. Transitioning from a private to a public company involves additional legal and regulatory steps. This includes seeking the assistance of legal professionals to ensure compliance with the requirements of the Johannesburg Stock Exchange, JSE, and the Companies Act. While the process can become more complex and costly as you move towards public ownership, each form of ownership offers distinct advantages and considerations. It's crucial to carefully evaluate your business needs and goals when selecting the most suitable form of ownership and navigate the formation procedures accordingly. Scenario 1. Starting as a sole proprietor. Lorato has always been passionate about fashion and has decided to turn her passion into a business. With a small amount of savings, she opts to start as a sole proprietor. Lorato can quickly launch her fashion retail shop without complex paperwork or legal formalities. She is motivated by the idea of testing her business concept with minimal initial investment. However, she is aware that this form comes with unlimited liability, meaning her personal assets are at risk if the business fails. Question: considering the risk of unlimited liability, what might be some steps Lorato could take to protect herself while operating as a sole proprietor? Scenario 2. Transitioning to a partnership. As Lorato's business grows, she realizes the need for additional skills and capital to expand her fashion retail shop. She decides to enter into a partnership with a friend who has experience in digital marketing, a skill set that's crucial for the next phase of growth. This partnership allows them to pool resources, both financial and skills, to take the business to new heights. The agreement they draft outlines how profits will be shared and decisions made, ensuring both are on the same page about the business's direction. What are the key components that should be included in their partnership agreement to prevent future disputes? Scenario 3. Evolving into a private company. The partnership has been successful and Lorato's business is booming. To further scale and perhaps bring in more investors or protect their personal assets, Lorato and her partner decide to register the business as a private company. This move separates their personal assets from the business, limiting their liability. it also opens up opportunities for attracting external investors. They go through the process of registering with the CIPC and drafting a memorandum of incorporation. Question: what advantages does transitioning to a private company offer Larato and her partner in terms of growth and liability? Scenario 4. After several successful years, Larato's fashion retail company has grown significantly. To access more capital for further expansion, and perhaps even go international, Larato and her board decide it's time to list the company on the Johannesburg Stock Exchange. This transition involves meeting regulatory requirements, drafting extensive documentation, and preparing the company for the scrutiny of public investors. Going public means that the company will now have to answer to shareholders, but it also means access to a vast pool of capital. Question: what are the key considerations Larato's company must address before going public to ensure a successful transition? These scenarios outline the journey Larato could take from starting as a sole proprietor to potentially running a publicly listed company. Each stage has its unique challenges and considerations, all aimed at growing and scaling the business responsibly and sustainably.
Thank you for joining us for this lesson. If you learned something, please give this video a like, share, and subscribe.